I wanted to chat today. I often get the question that, hey, if I want to be more conservative, I just put, more of a mix of bonds in my portfolio. And while that is typically the kind of age-old kind of answer, things that what people would say, it didn't work a couple of years ago when stocks and bonds were both down. But I think even more to that, the bond market is even larger than the stock market. And so navigating the bond market becomes even more important. So I know, Guy, you have a lot of experience. Your team has a lot of experience with that. So if you want to just hit on, I know when we use it, mainly it's individual bonds versus bond funds. We talked about mutual funds before and why individual stocks, but do you want to hit on, bonds a little bit and why we would use them, individual bonds, and the complexity of the bond market?
Yeah. So un unlike the stock market, which acts relatively efficiently, and that's really because there's only a limited amount of names. Every company that has a publicly traded stock for the most part just has one ticker symbol to it. I know there's a couple, like Google that has a couple based off of voting shares, but generally speaking, every company has one particular symbol. And in addition, technology has made it to the point that people can be trading stocks on their phones. So all these things have improved the efficiency, especially within the equity market. But when you look at the bond market, which is actually much larger than the equity market, when you look at actual cap size, the amount of money that's invested in it, you compound that with the fact that there's a lack of access to it. People, you can't just be trading bonds like you can with stocks. You still have to be going through a middleman, whether it's through a trade desk, that has built up inventory. That's really how most retail clients can get their exposure to bonds. So because of that dynamic of it being such a large market and still limited access to your normal investor, it creates the opportunity for inefficiencies. So if you kind of know how to look for that, you can start to take advantage of that. And for example, as managers here who can be buying outside of a trade desk because we're large enough to be doing institutional buying, going directly to a different dealer to be purchasing blocks of bonds. We often look at where bonds are trading compared to each other. So it's the spread analysis that's what allows us to determine relative value in bonds. But oftentimes we'll see we can buy a certain type of bond that's trading cheap to other types of bonds. And sometimes it's because the issuance is so low. And why that's so important is because most people get their exposure through bond funds, like you mentioned. But a large bond fund that's managing hundreds of billions of dollars or even trillions of dollars potentially is not going to buy an issuance that maybe only has $1 or $2 million of issuance out there. It's just not big enough to not even a drop in the bucket for the bond fund. But for someone like ourselves, for our clients, we can have a good appetite for that. So oftentimes we'll step in and buy that when there isn't other big institutional buyers because of the size. So that's one thing that comes about because of the inefficiency within the bond market that we really try and lean into and take advantage of.
Sounds good. All right. Thanks for explaining that.
Yeah.
And anybody has questions or want to get more in detail, we'd be happy to go over it.